Good morning. This is the Chorus Call conference operator. Welcome, and thank you for joining the Update Hedge Invest Newman Credit Fund conference call. After the presentation, there will be an opportunity to ask questions. At this time, I would like to turn the conference over to Mr. Stefano Bassetti of Hedge Invest. Please go ahead, sir.
Good morning to everybody. Thank you for joining the conference call of Hedge Invest Newman Credit Fund, our long-short credit UCITS fund managed by Newman Capital. I'm Stefano Bassetti, Head of Marketing of Hedge Invest. I'm in Milan. London, we have Mr. Filippo Lanza, Chief Investment Officer of Newman Capital and Portfolio Manager of Hedge Invest Newman Credit Fund. We sent a short presentation yesterday just to support the Filippo presentation. Please, Filippo, go ahead. Remember, at the end of your presentation, we will have a Q&A time. Thank you, Filippo.
Good morning, everybody, and thank you for taking the time to listen to our quick investment outlook. This investment outlook is for the Hedge Invest Newman Credit Fund. I'm sure you already received the recent performance, but just given that it's the beginning of the month, as a reminder, in August the fund was up almost 1%, it was 0.8%, and is around 3% for the year net of any fees. We're running close to $750 million now, and I'll move quickly to the presentation now. I think you received, I hope you received the quick presentation, the PowerPoint presentation we made. So I will refer to that, but feel free to jump. We'll try to make it quick so we can open up for more direct questions from any investors interested to do so. The first page we dedicated to the impact of quantitative easing, and specifically the one started from by the European Central Bank this year. What we see now is that the momentum of the ECB quantitative easing and many other quantitative easing is weakening, and is weakening quite substantially. And this is in conjunction with liquidity conditions which are increasingly deteriorating in the marketplace. I would focus first on the QE side. I think what we're particularly focused on is the time lag that we've seen between different quantitative easing programs, and we've seen that time lag shortening over the years. And probably the shortest quantitative easing until now has probably been the one started by the ECB, because they couldn't even get to the first 6 months of the program, and China had to react, entering into this relatively unexpected devaluation. Because of that, we are of the opinion that most of the quantitative easing that we see now, we're seeing quite a few macro blocks engaging into quantitative easing, and we start feeling that the marginal economies coming from the quantitative easing and the marginal impact on the security market is actually moving from very positive initially with US a few years ago to almost neutral, if not negative, and we'll go through in details on that. At the same time, I think what we noticing is a further deterioration of liquidity in the market. The price formation and transmission systems that we've came to know over the last few years is changing completely. Part of it, and the major driver, is the change in the investment banking community. We're seeing a decent amount of reduction of capital and a very strong increase in what I would say overall corporate governance or risk management rules at those places. So investment banks are moving more and more from risk taker to proper kind of order basis brokerage houses, and that's got repercussions. At the same time, we've seen a proliferation of very, very liquid instruments for the end investors. First and foremost ETF, but also asset management company with products such as daily UCITS. We are weekly UCITS, as you know, but daily UCITS, ETF, and any other kind of instruments which provide, or at least optically offers, a very high level of liquidity to the end investor, which we don't think is necessarily matched by the market picture. I'll just bring a very simple example there. Like we all think of ETF as the ultimately liquid instrument, and it's funny because with Greece, which all said and done, it's got nothing to do with with China in terms of magnitude and relevance, but even a simple ETF on the equity markets in China, in Greece, actually was suspended as soon as the Greek crisis started. So that's a good proxy and a good anecdote to keep in mind, yeah, for what is waiting for us. The page that we the following page number 3, trying to kind of capture what we're saying, that this sort of the marginal utility coming from the combined effect of the different quantitative easing program in the world is, we think, has reached a turning point. So we're getting very close to zero, if not negative at that point. And we've seen that in we put this Bloomberg generic 10-year historic yield. We've seen, of course, the massive, unprecedented compression over a relatively short period of time of yields in general across the term structure for most of the big macro blocks. But now, for the first time, we're seeing that bottoming out. And we think that move has to do with the re-emergence of credit risk. The credit risk component of most of the fixed income world has been camouflaged by the super rally of government security, effectively purchased by central banks, either by the central banks engaged in the program or by other central banks, for example, China managing their own reserves against the quantitative easing program. So because of that combination of quantitative easing kind of losing momentum across the world and at the same time lack of liquidity in the market, we came to the conclusion, and we had a good proxy in August, that even mildly negative or moderately negative news can actually have a disproportionate impact on the security market. That's what some people like to call the flash crash as the outcome of that. But I think it's quite important, because we may have a situation where, just to bring like a relatively extreme scenario, you may have a Lehman-like market environment without necessarily having something as disruptive as Lehman per se, because the transmission channel has changed. So he over-amplifies, he over-dramatizes, if you want, bad news. Page 4, we try to capture what we really think at the end of the day is the essence of the problem, and that's why we think we entering into a new stage at the macro level now. What we've seen since 2008 until effectively this year with the Chinese devaluation, I would say, just to pick a point, we've seen unprecedented monetary stimulus, both in terms of instruments. Predominantly in the past we use interest rate, now we use expansion of balance sheet for the central banks. Unprecedented in terms of size, both in absolute terms and relative to the GDP of most of the countries involved. And what the really striking problem here is that following this massive monetary stimulus, which has been global, because for the first time we're seeing pretty much every single macroeconomic block engaging in the same program. Nonetheless, the overall GDP, the overall economy has struggled to grow meaningfully, and we have not reached the same sort of GDP growth levels we've experienced before the crisis, which of course raised the issue of how much of that growth was powered by debt or leverage as opposed to structural drivers. But in the meantime, and that's the real focus for us as an asset manager, is that the amount of debt has been exploding. And we know, because we've seen it many times, at the end of the day, the gap between the debt and the ability of the company or the issuer to produce enough cash flow to manage that debt is a gap that has got a fine variation around it. And if it goes above a certain point, it has to be closed. And it can only be closed in two ways, either by increasing the cash flow generation, if you want the GDP, the inflation, whatever you want to call it, or alternatively by restructuring or reducing or readjusting the debt profile. If you look in this page on the left-hand side, we took a page from the McKinsey Global Institute, which is a fantastic provider of macro data. And if you look at that, you see very clearly that there's been no deleverage in the economy, not in absolute terms, not over as a share of debt over GDP. And if anything, we had a very meaningful increase from 2007, 2008 up until now. And that's been true pretty much across different sectors and countries, with some differences, but overall has been pretty substantial. There's definitely been a shift from financial institution, household, back to the government, but we think that is probably overstated. The one important thing from our point of view, from the point of view of investors, is that this explosion of the debt is actually many times is underestimated in most of the statistics or consensual research. And the reason why is because most of the people look at the debt in terms of notional. The reality is because of what we're seeing with the previous chart, with this compression of yield, that the present value, i.e. the market value of that security has been exploding even more. So most of these debt numbers are actually understated by 20 to 30%. Why is that important? It's very important because if you are an issuer, the best proxy for the cost of your debt is really going to be the market value, as opposed to the notional debt. So in this case, we seeing basically the market is, because of the quantity, is actually making the debt much bigger. Not just because it's grew up in terms of size, but also because it grew up massively in terms of valuation. And that is effectively, that pricing is related to the fact that there is no GDP growth, there is no inflation. And if you think about it, most of the monetary policy, most of the economic analytical framework that most of the policymakers use has always been confident that eventually a monetary expansion would have created more inflation and GDP growth, hence bringing down the debt GDP. At the moment, debt GDP has only gone up in most of the countries, and if anything, on a market value adjusted, debt over GDP has gone up even more. The perfect example is Italy. The debt GDP is very high, but still perceived to be sustainable when it comes down to the notional, which is around 136, 137, depending on how you want to calculate it. But at the same time, if you do adjust for the value, the market value of the debt GDP becomes a lot more unsustainable, and it goes probably past the 160%. So it's a very relevant notion, and we use this many times over the last 20 years in any kind of situation of debt restructuring. We always look at the market value of debt, because perversely, in any situation of stress we've seen in the past, typically the market value of debt is way below the notional, hence it opens up opportunity to restructure. In this case, actually, we have the exact opposite in the market. Page 5, that is the following page, is nothing else than the other side of the coin of what we just discussed, which is the lack of inflation. We don't have a crystal ball on inflation. We don't claim to have one, but is factual evidence that inflation has been going down, and it is also fair to raise the issue of whether there are structural drivers here, whether this is not just simply cyclical. We have heard that it is a cyclical issue and is only temporary due to the oil and commodity environment, but we heard that for a few years, and so it's becoming less and less credible, and credibility is going to be a relevant issue going forward. Page 6, we're trying to focus exactly on the other side of inflation, which is deflation, or call it deflation, lowflation, lack of inflation. Anyone can choose his own terminology there, and every central bank has got different preferences. But what is very relevant for us as an asset manager, as an investor like yourself, we don't really care where, or we don't want to spend too much time about the structural drivers of deflation or inflation. What is really important for us is that as long as they are there, or as long as there is something out there that is pushing for this, we need to be focused very much on the value transfer that inflation and deflation are going to create. Deflation per se or inflation per se are not necessarily bad. They are bad for somebody, they're good for somebody else. And that's something we're very focused. What we think is, because of this trend in deflation is new to the economy, because we haven't seen it for a few decades, at least in the developed world, and at the same time is so widespread, so pervasive. We need to spend a lot of time in terms of understanding where the value is being transferred, where is the new value being created, where is the old value being removed. And that choice, that analysis is going to be perfect. It's going to be fantastic in terms of creating opportunities for long-short strategies, both in credit and both on the credit and equity market. And the value transfer may be across the capital structure of the same issuer, or maybe across different issuers or different sectors, or even different countries. Net, we think the impact will be very, very big. We think there will be a big value transfer from, and I think it's pretty consensual, from emerging market to developed market. But I think within that, I think Europe per se, because of the current situation, will probably be one of the largest beneficiaries of this. But that's where we overall, as an asset management company, we devote most of our resources, time, energy to trying to spot what is the impact, and we think is going to be extensive and intensive, and is going to be affecting a lot of industrial sectors, a lot of financial sectors, and a lot of countries as well. A lot of investors have been asking, and that's how we try to shape the presentation, and on what is the next step, what we're going to see, what is the end of the game. A lot of people keep on asking. We try to kind of formulate an answer to that based on our experience, and our experiences of credit guys is people that eventually had to deal with issuers that had too much debt compared to their ability to generate cash flow. And so with the way we view macro, which is very different from most of the macro players, but is also what I think is unique in a way for our investors, we try to apply our credit analysis to the overall world. And I think for the reason that I tried to explain in the previous slides, we think our approach is very advantaged now. We have a competitive advantage. We have an edge because the world we're living in is a world of super leverage. And that's what we came across over the last few years. And I think because of that, we developed a few, instruments, a few sensitivities as well, and a relevant experience that I think will be quite useful going forward. So when it comes down to what is the next macro steps, we view three main macro steps. Yeah? The first one, which I think is where we enter with China, with the Chinese devaluation, is that we will see more and more monetary stimuli and more competitive across the world. And that is going to have a big impact on volatility, macro volatility, GDP volatility, FX volatility, but also very much revenue and income volatility across different sectors and different companies. I would like to point your attention to the chart on the bottom right corner, where we try to show the calendar for the different central banks' actions. It's quite interesting. If you look at that, you get a sense that quantitative easing is becoming a relatively crowded place. It started with only the Fed, and that's very, very good, very powerful. Surprise effect, only player doing it, innovative, and so on and so forth. UK joined very quickly, but again, probably not that relevant because the size per se was not that important, although UK is at the top end of the range in terms of their exposure on a GDP basis. In terms of quantitative easing, we're talking almost 50% of GDP is effectively held by Bank of England. As we progress in time, we've seen effectively more and more QE program being added. And as we see that is effectively the marginal utility of those quantities and the marginal impact on security prices moving from very positive to mildly positive, neutral. And I think potentially now we're getting to a point where, yes, we do need more quantitative easing. Yes, we will see more. But at the same time, because it's a quantitative easing which is made in conjunction with other countries trying to do the same, if there is no real growth globally, then eventually it's just becoming like a sort of a glorified devaluation policy, which at the end of the day is what really quantitative easing in the end are, especially for countries where there is no monetary policy transmission. That's true not just for ECB, but for a lot of the other macro blocks. So the first step we see is that we see an acceleration in monetary stimuli, an acceleration in those programs. We may see a bit of a preview already this afternoon with the ECB conference call. But increasingly, we will see the marginal utility of the combined, of the aggregated QE programs to be decreasing. if not going negative. The moment where that marginal utility will become negative is the next macro steps. Is the macro steps where we see a U-turn inversion of investors' trust. What I find quite challenging from an intellectual point of view is to see how irrational the markets are. The markets basically since 2008 started building a monolithic, unshakable faith in the ability of policymakers to control the economy. Yeah, the same policymakers that totally didn't predict the crisis, right? I'm sure you remember Bernanke minimizing and dismissing the mortgage crisis in 2007, even 2008. But the markets decided that the same policymakers that didn't get it right before, with the only notable exception of Bank of International Settlement, the same one basically have decided to effectively to believe that they're going to be able to do it. Yeah, and so far that faith has been unshakable, has been monolithic, and started with the Fed, eventually transferred even to the ECB after the 2011-2012 OMT kind of situation, and then of course to the Bank of Japan. The perfect example of that has always been China. China, by all stretch of imagination, is effectively a black box. There's very little disclosure. We had this issue with many companies in the past, and there's always been a negative start for us. But specifically, until now, that black box was viewed as a magic box. Policymakers there will always be able to fine-tune the economy. They can move the growth from 7.5 to 7.25. So the fate that the market had on policymakers on where the disclosure was even lower actually was to increase the level of faith, the level of trust. And only now, with these, of course, we're seeing, and it's funny, I'm talking about black box and magic box because I just read a piece of research from a prime investment bank talking about Pandora's box now. Because as people raise the issue of what is true, what is not, and they start digging for details, then they will realize there's very little disclosure. And lack of disclosure creates doubts and creates uncertainty. And that's what the market doesn't like. Now, our view is that as we see more monetary stimulus and as we see less input from that, especially in terms of growth, because at the end of the day, it's always going to be about data, we may have even more points of lack of faith, of U-turn in terms of trust. And because the consideration we made on the price formation mechanism, we think they'll create panicky moments on liquidity, and what we've seen until now, flash crashes. Some of the flash crashes we've seen are immense in terms of standard deviation moves, whether you look at it on an intraday basis, monthly, yearly, or whatever else, right? And we had recently on the equity, a few months ago, we had the flash crash on the Bund, both long and short, and then last year we had the Treasury. We think we're going to see more of those situations. Sometimes we have a pushback from the investors saying, oh, but they know how to do it, they know how to control it. I mean, our point, there are two big answers we give to them. Yeah, the first one is the Swiss Central Bank behavior. Swiss Central Bank and Switzerland in general has always been as a rock solid source of stability. Yeah, not just economic, yeah, political, institutional, everything. Them changing on the exchange floor overnight in an unexpected way, possibly under the pressure of either accounting issues or political issues, is a preview of what we will see. Yeah, the attempt, I think, of China to kind of control the stock market in ways that nobody would have thought that they would have tried, again, is another anecdote, another preview of what we will see. The second answer we give to the investors is say, okay, you may like or not our approach to macro, what we call macro credit. Yeah, we're just saying, listen, everybody is just a simple big issuer with a lot of debt, probably too much. So we need to use credit analysis. But at the same time, if you look at, and we talk to a lot of Fed, ECB watchers, and this is particularly true for the Fed. Yeah, those policymakers have themselves a very strong faith on macroeconomic models that clearly are incapable of managing the complexity that we see now in the world, right? Most of the macroeconomic models, whether they are monetarist or Keynesian or whatever they are based on econometric models which so far pretty much have failed everything. But they still have a very strong reliance on those. Having said that, central banks, as always, will behave politically if and when needed. So on an emergency basis, they will react. But that doesn't mean that in the short term, they're not going to be following the rules-based models they have, and that will create even more policy mistakes, we think. The perfect example we're making is that the fact that quantitative easing has been predominantly executed by purchasing government bond has been probably the worst choice of assets possible, especially with the view on potential inflation expectation. But anyhow, so the second macro steps we see is this. Is going to be a moment where we have a trust U-turn when the market mechanism is not going to be there, and so because of that we'll have plenty of liquidity issue. That's why we keep on building and keep on looking to build in the most kind of innovative, the cheapest possible way liquidity option around the book, because we think we're going to see many more of those, not less, and I think we will see an acceleration going forward. The ultimate step, which is the end game, if you want, is something that we can go through. But just to give a sense of what is the time frame for us, on the first step, which is additional quantitative easing, I think we will see plenty of that, and it'll probably be the next 6 to 9 months. Now, if there is no growth in those months, I think we will then be followed by those U-turns. It could happen in 3 months, could happen next week, could happen in 9 months. It's going to be very unpredictable, so then we need to be prepared now. But in terms of the quantitative easing response, I think what China has triggered is effectively a glorified competitive devaluation, like we've seen 1,000 times in history of finance. And I think that is going on. The U-turn can happen in different ways, different markets at any point in time. The end game, which is what we would expect to see, and that's what we dedicated page 9 and the following, the end game is effectively if we don't have inflation, if we don't have growth, we clearly have too much debt. Too much debt is a factual evidence. There's no much debate about it, especially on a market value basis, compared to the cash flow. So either we have the expectation that cash flow, that GDP is going to grow, with all differences across sectors, countries, or whatever, but either we have that or we need to reset the debt. And that's something very traditional, very normal in any credit cycle, in any credit environment we've been through, right? There are winners, there are losers, there are companies that need to restructure, a company going to restructuring, and they survive, either they die, either they liquidate straight away. But globally, if we don't see inflation/growth, especially on the global level, and the competitive devaluation are increasing, creating additional losses from volatility, risk, and all the rest, we will need to reset the debt. Now, how you do it, you have like infinite almost variations on how you can reset the debt. How you can effectively, by resetting, we mean how could you adjust the debt level to the actual cash flow level of the issuer. Now, we try to make it simple by saying that depending on which path you're going to go, which issuer, you can have very different prices attached to a debt reset. And that's why, again, credit picking, stock picking on top of liquidity optionality is going to be the overwhelming driver for us in portfolio construction and risk management. Page 10, we try to kind of give you a sense of what is like oversimplifying the 3 possible categories, right? And we call it the good, the bad, and the ugly. Reality is there's very few are going to be good for investors, right? Definitely ex ante. Most of them are going to be either bad or ugly. On the good side, I would put by far European countries in the monetary union. Those are the ones where the imperfect monetary union actually allows and produces many more macroeconomic tools than in a normal single block country or perfect monetary union. I know this is totally against the academic consensus, but I think eventually they will catch up with the realities that in the European Union, and sorry to be precise, in the European Monetary Union, the opportunity, the macroeconomic tools that the ECB or other countries have to restructure are incredibly rich. We've seen with restructuring of the LA made by Ireland. We've seen with the domestic debt restructuring of Cyprus, and we've seen it with Greece plenty of times with PSI, and now with the reprofiling of the public debt. What is interesting about Europe, and again, in a bull market for the last 5 years, people really didn't spend much time on the details, but Europe has created a lot more monetary policy tools and a lot more fiscal policy tools. The laboratories, the experiments have been predominantly Ireland, Cyprus, and Greece. Market has not appreciated enough, and unfortunately we're still victim of this intellectual superiority of economists and their kind of statement that the monetary union has less tools. Our view, our strong belief, and so far is a strong belief that made us money, is Europe has a lot more policy tools. We can go in details on separate conversation, but we've seen it with ELA, we've seen it with ANA, we've seen many times. In our view, the ECB and the European Union has at least 5 big, substantial, effective macroeconomic tools that no other macro bloc has. So if I need to look at the good, I would say most of the countries in Europe have a good chance. Greece on top of it, we really like it, and we can go through in details. Away from that, when we talk about the bad and the ugly, I think the bad will be countries that are not that relevant, because this is going to be definitely a big boy game. So small countries, those are going to be but with at least some sort of relevance, either geopolitically, like Ukraine, or some sort of asset base, like Venezuela, for example. So those countries will have an issue, but somehow they will survive, and they will still be countries. Where you're really going to get ugly, from our point of view, is on the corporate side, and possibly on on the financial side. We think there's going to be 2 big drivers there. On the corporate side, especially on the yield side, we have a massive bubble, something we've seen rarely in the history of finance. And the same rule is true that we learned a few decades ago, which is not a single corporate, with a notable exception of the Microsoft or Google of the world, but not a single corporate, when the debt becomes due, has the cash on the balance sheet to repay that. Most of them, they either need to roll the debt, or they need to find a solution, a settlement with their own creditors. And that's the history of debt at the end of the day. Now, we've seen we know that the refinancing environment has been incredibly easy, incredibly favorable, incredibly simple over the last few years. But at the same time, we know, and we see it now already, there's going to be a lot of changes, a lot of pressure. There's way too many companies that are effectively camouflage merchant banks that just invest across different assets on a leverage basis. They do rely on commercial paper, or they do rely on a yield market, a very buoyant yield market that will not be there. In investment grade, you need to be very, very selective, and I think there we need to choose the losers based especially on what the macro volatility is going to be, but there are going to be some issues there, some big issues there as well. So on there, in the corporate side, is where we think the restructuring will be more violent, more binary, and I think most of all, most surprising to a lot of the investors, because we think credit by far has probably been the best asset class over the last few years in terms of risk adjusted and volatility adjusted. So I think there is an overcrowded exposure there, and we think that's where we're going to choose and pick our shorts. That's a market we're going to trade predominantly from the short side, and I think there's going to be amazing opportunities. On the other side, we have the financial industry, and again, the financial industry has changed completely. Most of the liabilities issued by financial institutions used to be viewed as quasi-sovereign before the crisis. And now with the new regulation, new legislation coming in place, we effectively have pretty much across the world dedicated Chapter 11 and Chapter 7 for banks, which means that the room for mistake in financial institutions is going to be very, very, very low. We'll see good bank, bad bank split, we'll see burden sharing, we'll see a lot. Again, Cyprus was in 2013 a very good laboratory for Europe, but also for the rest of the world. And I think there we'll see plenty of situation. At the same time, we will have M&A activity, releveraging, and everything else. So there will be other trends that we need to kind of keep in mind in our evaluation, in our portfolio construction. But at the end of the day, what is going to be very, very relevant for us is that as opposed to a long trendy environment that we've seen for the last few years, we will be in a situation where the stock picking, the credit picking will be of paramount importance. And overall, we think the idiosyncratic, the credit risk will reemerge. So far, we've been enjoying super positive macro correlation across everything. Effectively, since QE started, everything went up. Simple as that, yeah? Whether it was bond, equity, credit, yield, investment grade, didn't really matter. What we know now is that as the refinancing cycle becomes more challenging, as the macro volatility will pick up, the idiosyncratic risk will reemerge, and in few defined spots will probably explode. So that's what we mean by the good, the bad, and the ugly. The good news is there's going to be some good, but the reality is that most of them are going to be either bad or ugly. A perfect example, to go back to the point about the restructuring in Europe, is Greece. I just want to spend 2 words. I know we've been very short Greece, and we did very well on the short side until July. We turned around the position. We're now long, which is exactly the same thing we performed in 2012. We started very short, and then we ended up long. Why? Very simply, Greece is probably top of the list of the good restructuring. That the capital structure of Greece is insane. To go back to the market value debt over GDP, Greece is probably in a very good position, especially if you look at the private sector bond. Greece is around 320 billion of debt, more or less. Of that, probably only 40 is in the private hands, investors like us, of which probably 10 is the notional of T-bills. So you're left with pretty much around 30 plus billion bond notional that trade pretty much at 60 cents on the dollar. So we're talking about maybe 20 billion market value. The vast majority of the liability structure there is in the hands of institutions, public institutions. So ECB, IMF, ESM, EFSF, and so on. Those institutions, differently from us, have the price issue. The price of their credit to Greece is marked at par. It's been marked at par forever. There is no loan loss provision there. They're very under provision. And that's one reason more why, on top of the other political reason and macroeconomic reason, they will extend again and reprofile the debt. So Greece will probably, between October and November, they will go through the reprofiling of the debt. That's not the first time. That's probably the 3rd time, actually, that they do. And then Greece eventually, after this exercise, will probably have the longest average duration of debt and the lowest cost of financing in terms of coupon that any country has in the world. On top of that, we think the ECB will be very happy to include them into the quantitative easing program. We think it's unlikely today to be announced, but it's very likely by October, November, when the review of the new program is in place, they will include them into the QE like they did with Cyprus, as we were expecting. If they do the QE on top of the reprofiling, you have a situation where the ECB needs to buy anywhere between, in our estimate, 1 to 2 billion notional a month. And with that in mind, the impact on the bond prices will be immense. And at the end of the day, Greece is probably the best restructuring we see with the lowest price because they're trading around 60 cents on the dollar. One interesting note to put there is that if Greece is part of QE, it's very important to think through the accounting of it. Yeah, if QE is executed, it will be National Bank of Greece to effectively create monetary base and then go in the market and purchase bond issued by Greece at around, let's say, 60 cents on the dollar. The moment they purchase those bonds, their cost of their profit on that, their net interest income, to use the accounting terminology that you would use for a bank, will be effectively the yield of the bond minus 0, which is the cost of the monetary base. Because of that, and if you assume they're going to buy, let's say, 10 billion in a year, that 10 billion will yield anywhere, let's say, around 8%. That means that National Bank of Greece will have 800 million euro of profit on those positions, which will then be paid up to the government in dividend. The reason why I'm spending time on that is because it focuses your attention on what any other national central bank is doing. Because if you remember about quantitative easing, which may very well be augmented by Draghi and team this afternoon, or next time if needed. The way the QE is executed from a cash flow accounting legal point of view is that each and every national central bank creates monetary base to effectively purchase bonds. But those bonds sit on their balance sheet. And because of that, of course, they get the income out of it, which then becomes dividend for the government. So it's effectively a debt buyback. We've seen many times, many companies that have cash reach, but they're not well perceived by the market, they do engage into buyback. It's something we're very used to it. Yeah. What people don't understand, and what they don't kind of elaborate as a corollary of that, is the implication for Europe, right? If you remember when QE was announced, everybody was very skeptical because they didn't do risk sharing. The market didn't like that the Bundesbank was now buying BTP. They didn't like the only Bank of Italy was buying BTP. But people misunderstand that, and they don't understand that that's, for us, being credit investors, as one precondition to make any restructuring in the future incredibly easy. I'll give you this example. If tomorrow the QE is extended or is augmented, and eventually you're going to have a situation where National Central Bank of Italy, it will have purchased by the end of 2016 something like 400 billion euro of debt. All of a sudden, you have a situation where every country will have bonds that they have bought back. So every country will be exactly in the same position where Ireland found itself in 2013. And what Ireland did then was what I would expect ECB and Europe to allow the countries to do, subject to fiscal agreements, for their own debt. What they could do effectively is that if tomorrow, let's say, Italy is in trouble, there is global deflation, so it's not an issue with Italy per se. So Italy is doing the right thing. Renzi is doing the right kind of fiscal adjustment, is approving the right legislative measure on the fiscal side. But still there is a global issue, there is deflation, there is no growth, there is unemployment. Then at that point, what Bank of Italy will be able to do is to say, okay, fine, these bonds are coming due next week, next month, next quarter. We're fine to transform those bonds into a 70-year bond, like you did for Greece, or like you did for Ireland. And the coupon, we may actually be happy to put it as a percentage of GDP. They can always engineer it, because they're very good at that, to make it on an MPV basis, which is equal to the value of the bonds they own, and which will probably be easier if the bond goes down because the market is worried. And so the moment they do that, they effectively are in a situation where the country restructures its own debt, because we are into this sort of ridiculous kind of assumption that the National Central Bank is, although it's consolidated within the balance sheet of the government, is still a separate entity. But by doing that, they effectively would restructure the debt, and they will make the cash flow management much, much easier for Italy itself, which means the other holder of the private debt, which are not part of the debt restructure, will be enjoying it very much with a massive increase in valuation. Now, you may think this is madness, but this is a combination of what the Bank of England has done, Greece, and Ireland. More importantly of all is Ireland. Ireland ended up being a very large holder of debt issued by the government in 2013. That debt was very expensive, amortizing debt with a very high coupon, around 10%. Very good proxy of what the countries in Europe would be if the situation deteriorates massively. What the ECB allowed Bank of Ireland to do was effectively to say, okay, that bond is very expensive, but for the government is coming due effectively in the next few months because it was amortizing. So we allowed the government to buy back, and they decided the price for that was par. The government at that time didn't have any money, didn't have any euro to buy that. Nobody would have lent them money to buy that security back. So at least not on cheap terms. So what the government did, they issued new bonds. And who did they issue to? To the market? No, they issued directly to the National Central Bank of Ireland. So the only thing that they bought this bond, which is very expensive, coming due very quickly, at 100, and they issued back to the National Central Bank of Ireland very, very long-dated bonds, floating rate note, at the same price par. So that is the template of that restructuring for Europe. Every time it will be different, so we'll have a combination of different bits and pieces imported from different programs, maybe a bit of Cyprus, maybe a bit of Greece, a bit of Ireland. But one thing which is clear to us, and we're very, very confident with that, is that Europe, and specifically under the guidance of the ECB, has developed an enormous amount, a very rich toolkit of macroeconomic tools to be used in an environment where deflation keeps on coming. So Europe, of all the macro blocks, is the one most prepared to deal with this. And I know it sounds probably ridiculous compared to what you read on the Wall Street Journal and the Financial Times, but we're super convinced of that, and we have the factual evidence to support that view. Ireland is viewed as a miracle. One of the reasons why it's a miracle is by doing this ELA restructuring that I just described, they created something around 25 to 35 billion euro MPV for the government, on top of reducing completely the cash flow needs in the short term, which is probably would make the estimate of the value created around 50 billion, which for a country like Ireland is massive. And that's one of the main reasons why Ireland became the miracle country that it is. A lot of people didn't focus on Ireland, didn't focus on Greece, didn't focus on Cyprus, but those are the laboratories that Europe has used to build very, very, very powerful macroeconomic tools. So on that, again, our job as an investor will be to have short on the bad and the ugly ahead of it, and possibly long on the good. And specifically within that, we remain of a very strong opinion that Europe is in a very, very good spot. Away from whatever the nuisances we're going to get and the noise we're going to get from the Fed over the next few days with the NFP numbers and everything else about policy normalization, we think overall Europe will start pricing this better risk, especially the institutional framework which allows more macroeconomic flexibility. I like now to conclude with this, and we'll just point your attention again to page 13 in terms of the strategy. As I said, our strategy first and foremost are relative value, long-short credit around events. We always need to have catalyst. So we have that for any credit issuer that we view, whether it's a government, whether it's a bank, whether it's a corporate. We think the world is so inundated with that is all about credit analysis. Yeah, macroeconomic analysis is irrelevant. There's not a single macroeconomic model that has been able to capture or predict anything that what we're seeing right now. So frankly, it's a waste of time. We do not want to spend time there. Where we're spending time, and we actually develop a specific software on that, is to spend more and more time on fundamental analysis, on research. We receive something like thousands and thousands of research pieces every month, and we're building a software to spend more and more time on the factual fundamental analysis, because we think that will be the biggest driver in terms of picking the winners and the losers, the deflation winners and losers, the competitive valuation winners and losers, and then eventually, if the end game that we think comes to fruition, the good, the bad, and the ugly in terms of position. On top of that, as I said, and I think I touched upon that a couple of times, but just to stress the importance of that, we are spending an enormous amount of time and a percentage of the AUM in producing and building liquidity option, long tail hedges. In the past, this is something that has been a drag on performance for both funds, both the hedge fund and the UCITS. But I think going forward, that will be one of the drivers of performance. And I think, as I said, we do believe there's going to be many more instances where we'll have flash crashes and liquidity issues in the market. With this, I just referred, the last page we put on the presentation is the organizational chart and different resources we have. And we're always available to have in-person meeting if you guys want to come to London. Whenever we roadshow, more than happy to go through and introduce you to the rest of the team. I just leave it now to the Q&A. If there's anyone interested in any topic on the fund, portfolio construction, or anything else, I'm here to answer. Thank you.
Excuse me, this is the Chorus Call conference operator. We will now begin the question and answer session. The first question comes from Ms. Luisa De Giorgi of Deutsche Bank. Please go ahead, madam.
Hello, hi, Filippo. Quick question.
Good morning.
View on the market. How are you positioned in the portfolio? What do you think will work in the next 3 to 6 months? More in the short term, let's say, into the year end. And what has benefited you? We almost had a preview of what can happen again, as you said, in August. What has worked and what you will continue to play in the long short?
Sure. The kind of position we have in now, I discuss, I think, Greece at length, so that wouldn't surprise you to know that we are long. We think it's going to be a very good catalyst. As always, for us, is a combination of fundamental drivers and defined calendar of catalysts. So Greece for us is a long. We like Greece and we like Cyprus because we think there's going to be more QE coming, specifically for Greece and for both countries as well. So that is a long. We are negative on Spain, so that's one hedge we have against it. We're very concerned about the Spanish election, not for anything else, but then again, like I said initially, even mildly bad news can have a disproportionate impact on the market. So we like to have Spain as a short. We think the long end could be very much unmanageable by the central banks, so we have shorts on the long end. With that in mind, I would emphasize that the purchase that the ECB has done are very much skewed in terms of duration. The average duration the ECB has been buying is close to 10, which is impressive because the market is not even half of it on an average basis. So that means the ECB has already done trying to do a super QE and clearly has failed, no matter what they're going to tell us today. So they may be doing more, but I think they may wait for that. So for now, we think they can only do more for Greece and Cyprus re-putting into the system. The rest can be under a little bit of pressure. So tactically, the short we have is Spain. That's where we see most of the pressure, and specifically credit for swap trades at a massive discount to the rest. And I think that's what we like to have. Away from that, on the corporate sector, we are very much short. We have short on yield names like, for example, Bengoa. Bengoa is a 10 billion market cap debt capitalization, not much market cap, but debt capitalization. Is a yield, one of the beloved names of a yield, and has been pushed up and down for the last few weeks on the expectation that they will go into a capital increase, which we think is unlikely. And today we came into the morning and bond dropped 20 points in the short end because it seems some of the banks are not going to be there to do the capital increase. So a yield and investment grade, we trade from the short side. On investment grade, we have a lot, and we keep on adding shorts, which have negative carry, but we're totally comfortable with that. Because I think on investment grade there are several drivers. One is the macro volatility. Two is going to be more M&A. I think we're going to see a wave of M&A, more activity, event, and whatever. So there we have short on investment grade, short in a yield, but we trade the short on a yield much more tactically. So we trade in and out. For example, Bengal we've been short for some time, and we still have a core short position, but we trade in and out of the bonds. So whenever the bonds goes up, we short more. When they go down, we cover. And those have been trading in a range on the bonds between low 40 and low 70s. So it's a 30 points change. Just to give you a sense of the volatility in the market, we've seen this double, like round trip, like 40 to 70 and back 3 times already in the last 4 weeks. I'm giving you Bengal because it's a big name, and I'm sure it came up in some newsletter with other investors. But overall, corporate, we're very short. On the bank side, again, there are good and bad. Yeah, the good thing is there is going to be more M&A. And I think there's going to be a lot more consolidation. I think ECB will push very hard for that. So I think selectively you want to have some small banks on the senior side to kind of take advantage of the consolidation. At the same time, you want to be very careful about the kind of subordinated side. On the subordinated side, we only like very good banks, but in this macro environment, we exit completely 81 subordinated paper. We're totally out of that space. It was a decent driver for us beginning of the year. Now we don't have it. We don't like it. I think it's too much beat in this current market. Away from that, we do have, and we do spend a lot of time on kind of super liquid stuff. There is a lot of liquidity in the kind of index liquid stuff, so that we trade more opportunistically whenever we have a strong signal from our credit analysis on the macro side. So whenever we look at things that may have an impact on the rest, we do trade opportunistically, and that's why we want to. We have on one side long tail edges, which we keep on building, and we trade around those. But the view again is very, very negative. We may have a very nice short squeeze if today the ECB is good and maybe NFP is not particularly strong, but the overall issue that we described before is a fundamental issue. Is only going to get worse. Yeah. Because the refinancing schedule is accelerating now. So basically, we trade from a short point, from a short side. So we have negative carry, and market goes up will probably hurt us a little bit, but again, not massively. and then we have specific views on debt restructuring. Anything that's going to come up, we're going to try to have a position either long or short into it. I hope that answered the question.
That's perfect. Thank you.
Gentlemen, Mr. Lanza, at this time there are no questions registered, sir.
Thank you very much. Thanks everybody for your time. And if there is any specific issue, you can address it to myself or Stefano or any other in the investor team, Nico, Laura, and we can always have follow-up meetings or conference call if needed.
Okay. Thank you, Filippo. Thank you, everybody. Bye-bye.
Thank you. Many thanks. Bye-bye.